Good morning, everybody. Welcome to the Flow Show. It's Monday, 5th of February. Here we are in a new week, ready to do better with the markets. Morning, K-Man. How you doing, mate?
Hey, good morning, Ryan. Good morning, everybody. Yeah, new week, new dollar. And we're ready.
Indeed.
I guess we're ready. Today is actually okay, we're going to get a lot of speakers, but today is actually sort of the biggest data day of the week, isn't it? Apart from RBA, of course. But I mean, the data, we had the PMIs, we have PMIs this afternoon.
Yeah, definitely. There's a few other bits and pieces to look at, which we will look at, obviously, latest week, Canadian jobs, that sort of thing. But yeah, a bit of a busy one to kick off, which is a bit unusual because usually the week after the NFP week, it's a fairly quiet one. So yeah, it'll get us nice and woken up this week anyway, better than the boring Monday we had last week, if I remember. So let's get stuck into it then. Let's see what's going on. Over in China, China's Securities Regulatory Commission, CSRC, kicked some doors in on Sunday and vowed to prevent abnormal fluctuations in the stock markets, saying it would guide more medium and long-term funds into the market and crack down on illegal activities, including malicious short selling and insider trading. That hasn't done an awful lot to Chinese stocks, which are back on the slide once again. We're getting a lot of stock markets slippy and slidey down to fresh lows, as you can see there. The let up is not coming just yet. So not looking too good over there at the moment. They're fighting fires and seemingly losing at the moment. Which makes us think, Kay, what do they need to pull out to turn this around? They're intervening, they're cutting rates, they're cutting the big rates, and nothing's working.
They need to produce real better numbers at one stage to get the investors back. So what I've been saying, I think last week we talked about that as well, and it's really, they need to get investor confidence back, and if they get that back, then the whole thing is possibly going to turn around. But I think we're still in this mood that investors are not confident, and yeah, it's just people managing their portfolios. Oh, I want to have, or I wanted to be in China. Perhaps now I don't need those 10% or 15% that I want, but only 5%, and that is just what's ongoing. The thing is, though, we all know what's happening in markets, and when the whole market will be saying like, okay, now we don't have any Chinese assets anymore, or very little. Perhaps the slightest little positive, really positive spark is going to bring people back, and then you will have the opposite. But where's the bottom? That's a very good question, and I just don't know, and I'm not ready to yet try to figure out if we are at that bottom right now.
Yeah, exactly. And it wouldn't have helped with Trump coming out over the weekend in an interview saying he would slap 60 to 70% tariffs on China pretty much straight away as soon as if he sets foot in the office again, the Oval Office again. So that's not hurting, not doing anything for sentiment over there as well. And that's still a big part of it. It's the international view of things, let alone what's happening over there domestically. But on the data, go on, mate.
Yeah, the market at times is already trading as if Trump is the next president again. We've seen it on the MEX, we've seen it in China. It's quite interesting to see actually these moves and these reactions in the market to what he's saying right now, and without any judgment of any kind. Is just interesting, and it gives us the perspective of what the market may be doing in case he gets back into the seat.
Yeah, very much so. It's been a bit surprising that it's all he's sort of become number one contender, in literally the first couple of weeks of starting off all the primaries and everything. And yeah, so it's a bit of a, like you say, a bit of a foreshadowing, shall we say, of what may be to come as the race continues for the presidency and if he takes the seat. Over on the data front, talking about China, you wanted a bit of an improvement in the data. There was a little bit of improvement on the data. Well, I say a little bit improvement. It wasn't. It came services PMI, which we're getting from around the globe, came in at 52.7, missing expectations, down a little bit on last month, but maintaining the positive number at least. So still keeping its head above water. Over to the BOJ, not a big headline, but apparently they're going to seek public opinions on monetary policy and its long-term review of its past monetary policy. I don't know how much input the public will have on that. Kay, do the public follow monetary policy closely over there in Japan? You know,
well, there's been a lot of moaning going on. So
yeah,
I guess depending on who they interview, that's the other question. Who is going to get the question asked? So it's not something that is common over there. But
are they more knowledgeable on policy over there than say people? You know, you ask average man on the street here, they wouldn't know what the interest rate currently is.
well,
Are they more knowledgeable?
yeah, I'd say the new generation is probably the new generation is probably the older generation. I don't think they really care too much because they've also been in what is it, more than 20 years, 25 years of interest rates going down all the time. So that's been a whole generation, really. So, but I think the newer generation may be more interested. But and you always have to look at, is it monetary policy or the economy, or what are they really interested in? But I would say there has been a bit of a change compared to before. Before they weren't consulted at all at any time, and they only could vote and for governments and stuff. But I would say the newer generation is probably more monetary policy. Not attached, but knowledgeable, because we also know that there's a huge percentage of day traders as well, which has been massively accelerated. The number has been massively risen during the pandemic as well. So I guess we can say that there's a bigger percentage now than there were 10, 15 years ago of people who know something at least about monetary policy. But now it's all relative, you know, it's all very relative.
Yeah, cool. Thank you. Right, just as we were talking about China, there's been some more headlines out from the CSRC. Apparently, the Chinese government visited listed companies in 20 provinces as of Sunday. And it's helping companies, listed companies, solve problems. They vow to boost listed firms' investment value. So that problem with the stock market's obviously hitting the values of listed companies. And so the regulators have been forced to go knocking on the doors of some of these companies and cap in hand almost saying that they're going to help them out and boost their listed firms' investment values. How they're going to do that? No idea, but if they want to do something, the Chinese, they'll go ahead and do it. So I think we should probably prepare for some action over the next few weeks in terms of that, propping the stock market up. Right, back to the data, because it is PMI day. There's plenty of bits and pieces out. Australia, improvement in services there, 49.1, still below the expansion level at 50, but going in the right direction. German trade balance improved, a bigger surplus there, 22.2 billion. Looks good news. Then you look at the actual activity numbers, which don't look like such good news. Exports down 4.6%, imports down 6.7%. So activity-wise, not good, even though that trade balance is improving. So no lit up for the negativity in Germany. Spain services as well, missing expectations by a pip, but again, an improvement over last month. That's the first reading from that, not the final reading. They only produced one. Same with Italy there, into expansion, 51.2, so beating expectations and last month. So again, a bit more positivity there. France as well, beating expectations, and these are the final numbers, but no improvement over the prior one. In fact, going down a bit as well, or prior month, 45.4. Germany as well, there or thereabouts over the flash number, still a negative over last month. The pan-Eurozone number as well, coming in same as the flash number, confirming the downward move. UK blowing the doors off again. These are the final numbers. So the flash was 53.8 and the final was coming in at 54.3. So much more improved there for the UK. Not that you'd know it by the level of the quid at the moment. We're trading other things. The pound hardly blinked over those numbers. Eurozone PPI feeding into the inflation picture. Their year-on-year numbers just down a pip worse than expected, down 10.6. Month-on-month coming in as expected, minus 0.8. But now we are seeing negative numbers on all these. So it's no longer prices rising at slower pace. It's now prices falling. And falling quite a chunk as well. So a bit of a trade-off here between what we're seeing in these sorts of numbers. Now look for all these PPI numbers, all going through back to Australia, China, Japan, Europe. And the big theme is that price pressures are evident in all these, with wages being a big driver of this. And this is something central banks have been warning about, particularly the ECB, who have made it almost a precondition that easing wages would help them on their way to cutting. Well, it seems that's not the case right now. So potentially some inflationary pressures in the pipe as well. Going back to Friday's data, obviously NFP was the big standout one, really kicked off markets, adding to what the Fed was saying, also pushing back on early rate cuts, saying the economy isn't warranting cuts. The jobs market certainly indicating that. 353,000 jobs added onto that. Expected 187. The prior got revised up to 333,000. If I recall, it was 216,000 last month, if I'm not mistaken, or somewhere around that. So decent revision there too. The unemployment rate coming down a pip. Over expectations, 3.7, which matched the prior month. Participation rate stayed unchanged, so no big movements there in terms of unemployment. But another big number, average hourly earnings up to 4.5%. There's those wage pressures evident. Was expecting unchanged at 4.1. It was prior at 4.1, and that got revised up as well. So everything's getting revised up. So there'll be something for the Fed to keep an eye on there as well. So that all added to further push out of March expectations. It also saw a little bit of repricing in May expectations, where Fed swaps no longer fully priced a May rate cut. The market really getting a wake-up call after the FOMC and these numbers. The early rate cuts are very unlikely if the data continues as is. Kay, what did you make of those jobs numbers? Bit of a surprise. We did have some of that revision business going on in there as well, but yeah. On the face of it, strong.
Very strong, very strong. I'm straight away going into something that isn't shown on those things, and that people have been talking about for about a year and a half on those people taking multiple jobs, and then that we were looking at layoffs and things as well. But if you look at hiring numbers, they are still pretty solid, even if it would be a seasonal number, and we had sort of the same kind of number last year, if I recall correctly, and but yet the market still reacted on the positive side to the dollar. This number is well, I mean, I think we're looking at it like most people are, like we're perhaps half of disbelief, but the number is there, and you cannot ignore the data. And since we have been banging on about the fact that we are data dependent, those data are very, very high. And if next month those data turn around and show revisions and stuff on the way down, that will that will be for next month, and unless we get panicky numbers between now and then on the jobs front. But as I've been saying for a long time, the employment market is one of the last big dominoes to stand, preventing the Fed or any other central banks from really starting to cut quickly and heavily. And we've got another confirmation of this. So where on Friday I was like perhaps leaning a bit to the other side, because the risk was there with the layoffs that we've seen. That's been thrown out of the window, and one has to acknowledge that, and that those numbers are still extremely strong. And it's global. It's not like one single area being singled out. Yes, there are more sectors which show better than numbers than others, like leisure and hospitality, healthcare, education. But it's not just like one sector. It's a bit of a global phenomenon, and whether they're part-time, full-time, seasonal jobs, the number is still there.
Yeah, very much so. And you know, again, it was a bit of a wake-up call for markets. Again, have been trying to price cuts and whatnot. You know, after the FOMC pushback, after this data, which has pushed back that as well, it's finally shaken the market to you know, get rid of these early rate cuts. They're still pricing an overly large amount of actual cuts. The Fed's still expecting 3, and the market expecting 4, nearly 5 cuts. So there is still a bit of significant pricing or repricing to be done, or incorrect thoughts, shall we say, rather than using pricing all the time. So there's still, you know, if data continues like this, we're going to get more moves, and the dollar is going to continue. Now maybe we're finally starting to see some of the breaks of these ranges that are going on, but we'll talk about that shortly. Just covering quickly the rest of the data. We had factory orders coming in positive, but missing expectations by a pip. Durable goods was there or thereabouts. The revised numbers there, no real shocks on that. As was the Michigan consumer sentiment, a little bit of an improvement in the numbers there. Inflation numbers, again, there or thereabouts. 1 year coming down from last month to 2.9%. 5 year staying unchanged at 2.9%. So no big moves going on there. Still inflation well above the Fed's target for that. Fed's Goolsbee said that the strong hiring hints at a productivity growth burst. He says that we wouldn't want to make much of any 1 month, but the continued strength of the labour market, if that continues, would lessen my worry that the jobs market side of our mandate is deteriorating. So he's seeing soft landing coming in with all these numbers. Fed's Powell was out at this everyone was looking at this 60 Minutes interview this week. We've had it posted about 20 times in our chat room this morning and afterwards. No real change in any of his rhetoric. Said it's unlikely the Fed will have the confidence to cut rates in March. All the rest was pretty much as per the FOMC last week, just reiterating all the stances from that. The OECD has raised 2024 global growth forecast to 2.9% from 2.7%, left 2025 unchanged at 3%. You can go and read all the waffle that these clowns come out with, another lot trying to guess expectations. Speaking of Trump, he said he would replace political Powell as Fed chair if he got in the hot seat. So if he does get in, expect some changes at the Fed, which is probably going to be the biggest market mover of the whole thing if he does take over, who would go in as Fed chair. Jobs front, SocGen going to cut about 900 jobs at their head office to cut costs, reports the press on that one. So more banking sector jobs going there. Okay, any other bits and bobs you want to bring to our attention?
Not really. Oh, yeah, the ONS, yeah, the UK labor market seems to be in better shape than what the numbers are saying. They revised some stuff and they came out with a number below 4% unemployment rate. That is another good news. Another proof that the UK is such an exceptional place to be, right?
Yeah, yeah. You know my thoughts on the ONS. They
Yeah,
couldn't predict the sun coming up. So
hey,
yeah, I'll take all that with a massive pinch of salt. But
yeah,
numbers are numbers.
Yeah, you can put them all in the same bag, the OECD, IMF, or ONS, and next quarter they will revise it to the other side. They
Yeah.
probably hired all of them. They probably hired some of those Canadian ADP clowns, right?
Yeah, and the stats can
Over
roll.
time. Yeah, no, for the rest, nothing. The only thing I just wanted to remind people listening to us, because there's been a lot done about this 60 minutes interview. The interview has been taken before the NFP numbers, okay? So that is something that we should all be aware of. To me, there was absolutely zero new. They were trying to figure out whether he was going to tell something about it, about these expectations and stuff, but he's still seemingly ruling out or pushing back against March. We never say never. Of course, there's also always like a very, very small percentage of risk in everything or for a change. But yeah, and then they were trying to say he's hinting at like mid-year, which is roughly what we've been expecting as well, May, June. But again, to me, not a lot of news in there, and especially people should know that the interview was taken before the labor report, and he did not really give too many hints about it either.
Yeah, very much. So yeah, we'll move on from that one. Nothing to see here, basically, from that. A lot of people expecting something more. I don't know what more people want from that, but that's markets for you. Right, let's have a quick look at what's coming up. As mentioned, we've got the US ISM services this afternoon, so that'll be pretty hot later on if it follows the same theme. If it's more US exceptionalism, shall we say, this time around. So it could be an additional driver for the dollar and yields later on. The RBA tomorrow, I'm not, or overnight, I'm not expecting any waves from these guys. Probably a sitting on the fence meeting. There's no reason to rush into cuts. There's no reason to rush into any more hikes either. Inflation, they may touch a point upon that sticky number that we got last month, but otherwise, all the rest seemingly moving in the right direction. So probably a bit of a neutral run, warn on the risks, warn on both sides of it, and moving on from that. The only thing I would look out for is if we've got this dollar strength, US dollar strength, continuing over the RBA, and they give anything that lifts the Aussie dollar, that's probably going to be seen by a lot of the market as a good selling opportunity. So if you are up and about trading that, just look at that as potentially one idea to watch if you're trading it. Eurozone retail sales tomorrow. And we also get to see how crappy or not German manufacturing orders are. Retail sales will cover the December period, so we'll get those holiday numbers as well. On to Wednesday, not really an awful lot out. Italian retail sales. We'll see the NBA housing numbers, which had a little dip last week. That might have just been some washout from the strong first couple of weeks we saw of the new year. Consumer credit, we'll keep an eye on, or I'll keep an eye on that just to see if there's anything untoward in there. Credit, how that's been growing, if it's going to signal any problems with household finances and whatnot, if they're feeling a bit stretched. But given all these wage numbers and job gains, that shouldn't be an issue. Another one to watch Thursday morning, we get CPI from China, which again could be a big number if it continues to confirm they're in possibly a little bit of a deflationary spiral going on. PPI numbers there as well. So still not going well for China, but those numbers, we've had a couple of negatives months, another one, and it's going to start looking like a decent trend. And on Friday, Canadian jobs, that'll give us something to get our teeth stuck into for the latter part of Friday. Well, depending on what the numbers are, we know what StatsCan are like with popping up the numbers, but that'll be something for loony traders to watch. Anyway, right, so what's going on in markets at the moment? So I mentioned we're getting a few levels looking like they might be cracking. Cable's one of those. Let's just bring it down a bit. This 126, 128 range looks a bit under fire. We've had a little move through 126. We had a test this morning. It held, it bounced. Now we're back below. It's going to be key here to see if we start finding 126 as resistance. We haven't yet had a real break, real test of it after this break. So if we get up to 98s, 99s and it starts resisting, then we could be on for a bit of a break. I suspect we've had a few stops go, but I think we see things picking up steam if 125.80 breaks. I would not be surprised if we're down in the mid to low 125s pretty quickly thereafter. Sorry, Kate, you was...
Yeah, no, I was just acknowledging what you're saying. The last times that we had a visit around 126 in the cable and below, the bounce was immediate. And now we are just hanging around here. That may be hinting at something. Something has changed in the mood. I also thought this morning, wow, quick stop run below 126, and then we'll see if it bounces. But it just hangs around here now, and that's the States will probably decide upon a lot. But that just tells perhaps that the mood is changing a little bit.
Yeah, you know, it's been a big move, so it has come a long way from Friday, you know, up into the high 127s, and now we're looking at 126. So maybe there's just a bit of steam running out of this move. But, you know, if the US come in and decide to pick up more dollars, then this is probably going to be, as I say, heading quite a bit lower. Euro dollar as well. Been talking about this for weeks. The bleed. It can't really, well, I say it can't find a bid. It was volatile enough there, but the rallies keep getting hit and we keep making lower and lower lows. We're now through the 50 fib of this whole move. So this trend is potentially now breaking down. The decider for that is going to be down at the low 107s, the big old 107 level. And we've got the 61.8 fib of this move as well. So at the moment we're carving down. Again, will this be a bit of a stretch point for this move for this year, or are we going to keep going? I think this one, along with dollar yen, is going to come down to what happens a lot in yields at the moment. Dollar yen had a little look up at this 148.80s area. It got rebuffed. It's had several attempts up here. One here, we could call that half an attempt. One here. And then when we originally had the breakdown, we had it becoming resistance here as well. But as you can see, it's been a level pretty historically as well. So pretty important. That pretty much also has coincided with yields holding, US yields, 10s particular, getting up, but holding around the 4.09% mark. So we couldn't quite get back up towards these highs. It's still looking fairly positive. But maybe for dollar yen, it ran into its own tech levels around that 148.80s, irrespective of what yield's done. It's had a little bit of a pullback. But yeah, I suspect, like the others, it's waiting to see what the Yanks are going to do when they come to the table. Aussie dollar, another one. This one looks a bit more breaky. We've had this move now under my zone. The zone is now holding as resistance. So that's what you want to look for when you're looking for a break. How is the break happening? We've had breaks here and it got back above. Now we had a break here and it's holding below. So that suggests we're heading lower. But we've got this last line of the sand down here, 64.85s. So it's going to need a move under that and a proper break of this fib to get this running lower. And again, then we come down looking at the next levels down below, low 64s. So this one looks like it's holding the break for the moment. That's what I'm sort of looking for in cable. If it holds the 126, then it suggests we're going to be heading lower as well. US stocks, also keeping an eye on that one. A little bit of a Brucey bonus on a Friday night for me, seeing this rally right up here. Real turnaround it was. We're down testing this 147, this 49 area, 49.05. That zone has held, then rocketed up to a new high. We've just eased off of that, so I'm waiting to see how the price action develops here. We may be building a little bit more support short term around 44, 45. But we've got all these intermediate lines which got blasted through initially, but I'm just going to look to see if we start to build something a bit more here. Okay, that was a bit of a surprise on Friday. It's a bit strange. Strong data and strong stock market. That they don't usually go hand in hand.
Yes, they can. That's what I've been saying a while as well, and that's why I had before the number came out. Oh well, once the number came out, I said I have those November vibes where, but then the dollar was a bit too strong. But I had those November vibes. What when you have really great numbers, that's not necessarily bad for the equity markets, and that's exactly what happened then. But it still looks like S&P and Nasdaq versus the rest of the world. But it is, in my opinion, is not completely unexpected. I said it. I mean, there's a possibility that the stocks like this, because when data are good in a country or or on a continent or you name it, it can be good for all the assets. So yeah, it will have put upside pressure on the yields market. Bonds a bit lower, needing to price out rate cuts. But on the other hand, you have a very good number, and that's usually relatively supportive. I know the market has been trading stuff differently, but that's one of the older correlations that I would say that are coming back. So yeah, and then you see where it also helped the S&P. People were talking about these 4,900 already. We had a bit of a retest then on the numbers coming out, and from then on we just continue to push higher again. And there will perhaps be a moment where, if the market needs to reprice the expectations more, that it may kind of weigh on the stock markets just a little bit. But I would rather say it's probably going to weigh more on a Nasdaq than on the S&P, perhaps. That's how I would look at it. But for as long as we are in soft landing, we are in this global mood in the market. This is not, especially not the S&P, is not a market where I'm going to look for, all right, we've seen the top, now it's going to collapse. The opposite may be true. If we are going to get really shitty numbers if we get really bad numbers, that you may have like a knee-jerk reaction higher, and then the turnaround. That may be true, but you're going to have to see bad numbers really showing that the economy is turning around for the worse.
Yeah, very much so. I mean, it'd be a surprise if we just all of a sudden changed the rhetoric on, what a more, I wouldn't say hawkish FOMC, but a less dovish FOMC. The reaction straight after the numbers was, as you would expect, good numbers, stock market comes off. And it took a bit of time before it decided it was going to really take off again. So I'm loath to say, yeah, we've gone back to old ways where good data is good for stocks. But, maybe the tides are changing. We'll have to keep an eye on it. But, here we are with the DAX. The German economy isn't exactly going gangbusters like the US. but stocks here remain resilient in Germany. You know that you haven't got the same effect there, so it's not wholesale across the globe. These changing, and it's still a very difficult situation to grasp for stocks. You know, I even said it on Friday. When you look at some of the numbers, you think, well, how are stocks trading like that? Why are stocks reacting the way they are? When you've got an economy that's pretty much the growth engine of Europe, and it's broken down on the side of the road with the engine falling out. And here they are, stocks still up at these highs. So yeah, it's difficult. There's times when, if you don't understand really what's going on, that's when you just revert to trading the levels. Trade what it's doing. Worry about the reasons afterwards if things aren't clear. They're certainly not clear for me here. Anything else that's clear for you? Okay, you want to have a look?
Clear? Yeah, I can have a look. Clear is a big clear is a big word, but yeah, Brian, I'll have a look at the dollar Swiss. I just want to comment on what Horatio is telling us on the Tokyo CPI. Yeah, it's come below the 2% for some measures. Other measures are still a bit above, and but we know, Horatio, as well, that the Bank of Japan, the government, are very much looking to what the wage situation will be, and towards the second half of this month and March, especially, we will have a much better idea on how this wage situation will look, and then we will have a look at how real wages will behave, and that's one of the main things that the Bank of Japan is looking at now. What the CPI does is actually pretty much in line with what Ueda told us that he was expecting in the second half of the fiscal year, CPI coming down, but then he also expected to rally again. So I don't think that actual CPI prints, especially not the Tokyo one. If you take the national ones, I think we should look at the national ones. Tokyo, I know, is like 25-30% of the of Japan's economy, but it's we have to look at the overall picture, right? I wouldn't really look only at what's happening in Tokyo, and not only also look at CPI, what I've already been saying as well. For the time being, I think they are on the path still of normalization, and the degree of normalization will, well, by the markets, I guess, will be decided or thought about by the markets, how those wages will be. If we really get pretty solid wages above the 3 I think it was 3.8 average last year, above that 3.8% average, then I think the market is going to look quite positively towards what the Bank of Japan may be doing, and then you will see some price moves in there. You will see the JGBs moving. You will see the JGBs probably moving much closer to that 1% mark where we are now. The 10s are trading around 70 BP. So that's regarding what you were saying on the CPI. Okay, so we are here around the 70 BPs mark. All right, back to other markets. Euro dollar, as Ryan was saying, is just we had this move back up. We even went back above this little channel that we were forming, but a lot of algo ticks. I think it's relatively important already that we're holding below 108 now. Having the break here, 107.60s. It's been a bit of a level, but I wouldn't hang my hat onto it. I'm going to rather look at this level here. I do have a put running on the euro dollar. I'm actually also scalping a few shorts just to be in it, because I think the dollar should really do pretty well. But you have to choose again your dollar wisely. For example, as Ryan already mentioned, the dollar yen is capped up there. I bought it last night, but I've already let a part of it go for not a lot. We have to respect this, and I think that comes because of. I know it's only the 4 hour, it's not the daily cloud, but look where this euro yen is also capping all the time. We've had this high here end of January, and now we are again banging our head in the 160s, and we had a pretty decent move back down already on the euro yen as well. We are already back into this prior little channel by moving back under 159.60, and we're seeing it also in other pairs. We had a move back above this line here in Aussie yen, and gradually we are rejecting moving averages. We didn't even have a retest really of this broken trend line, but we did have a retest of the prior little spike lows, and it stopped there. And we see the same thing on other yen pairs here as well. This we could still be in some bullish, whatever you want to call it. I never know exactly what it's called, but if I'd keep an eye on what's happening in the mid 186s on sterling, and so the yen is not completely enjoying the whole thing. Could be just technical, but could also be that people are saying, well, the dollar is all well, is okay and well, because the dollar yen really did shoot from those lows that we saw around and just below 146. We went into the NFPs around 156.5. We did two big figures after all, so there may be a bit of correction in the dollar yen, which I think is very possible. Perhaps down to somewhere in the high 147s, perhaps. But the crosses on the yen are telling me that the market is still not completely on board with a lower yen, and probably still trying to trade what's to come in the Bank of Japan. So if you trade yen, don't only trade the dollar yen. I know it's been doing a top here, but it's also been capped by some of the yen crosses. All right, right, Swiss. Ryan, by the way, did you show the Aussie dollar or not?
Yeah, I did. I did briefly.
Okay.
Yeah.
All right, Swiss, because I know people are interested in it. I think for all Swiss pairs to really move up, we still think, and it's like a bit of a global thought in our community, that Swiss is over time a currency that should always speak in a conditional way, should weaken a bit. But this is going to be a key to what's happening in the Swiss, and it's not been very cooperative. This Euro Swiss. It's not been very cooperative. I think we really need to move, and we tried it again this morning, but we really will have to move back above this 93.60-70 to move higher in the Euro Swiss, back into the 94s. Okay, and that's going to be one of the keys. Just like Euro yen may be a key for the yen trades, Euro Swiss may be a key for Swiss trades. All right. Whoops, that's not the correct one. On the dollar Swiss, in turn, we went into the NFP right on the support, 85.5. I've been highlighting this level a good number of times. We're right into the support. I was like, actually a bit ready to celebrate if the report would have been bad in the US, but then we saw a big rebound, same as in all dollars. But again, here we're running into a bit of trendline resistance. We're also approaching the prior highs on the January highs on the dollar Swiss, and there's still a lot of work to be done on this one. Okay, it's Swiss. It could go very, very slowly. We had Ben in our room showing a very nice harmonic, thinking that showing a possibility for a return over time back into the 90s, the way it trades technically. But I would say that before that happens, we really will have to. There's going to be work to be done, and that work is really going to take a big figure. And as I've been repeating many times, whatever those lines or so may say, for me the magic level is still going to be those 88s, those low 88s. If that goes, then I think something is really changing for the Swiss franc. Okay, that is still the level. In the meantime, I'd say supportive, but respect those levels. So for people who are long, I wouldn't refrain of trying to take some off, trying to rebuild perhaps on setbacks. But there's just my personal opinion, of course. I'm still running my calls. We are turning around my strike actually right now, but they're still running for about 5 months or so. So that's it for. Oh, quick look on the metals. Yeah, oil. Oil 79 a quarter, 76 $3. We are already below this target here. It's really not looking too fresh. It's trying to break this support, and we could have a look again at 70s. And then there's something really strange, because the dollar CAD shot up, but then if you look at stuff like the Canada crosses, Canada is actually not weakening, right? It's not going any weaker, and we are on prior lows here in the EuroCAD, and that one to me is still looking a bit fragile. All right, despite those lower oils, so could have already an early expectation of the well, it's actually not even the Bank of Canada, it's the no, that's too early to trade the job expectation in Canada. But it's quite remarkable to note this. I think it's interesting to pay attention to this. And Ryan, I think that's enough for today. For people trading metals, it's looking a bit fragile. Probably the dollar side. If gold starts to break under this 2020, we could see a quick move down to low 20s. Silver is also looking a bit fragile, but I think somewhere in the 22s we may start to see some better support. Back over to you, Ryan.
Thank you very much, mate. I think that's enough for today. Getting us all set up for the week, so we'll call it a day there. Have a great week, everybody. Thank you for coming to the Flow Show. We look forward to seeing you the rest of the week. Thank you, K-Man, as always. Yeah, have a great week this week, and we'll see you all tomorrow. Cheers.